Hi everyone, welcome to Eco Learning Classes. This is Professor Geeta Mahesh. Dear students, today we will be discussing methods of measuring national income. There are three methods of measuring national income. One is product method, income method, and expenditure method. Sometimes for 2 marks, they will ask question like mention methods of measuring national income. If you mention these three methods of measuring national income, easily you can get 2 marks. Now let us discuss how to calculate national income by product method. See, under product method, we are going to consider sum total of all final goods and services produced in the economy. And we know that economy can be divided into three sectors. One is primary sector, secondary sector, and tertiary sector or service sector. So you consider the total production taken place in the primary sector and deduct intermediate goods that are used to produce the final goods. Then you will get a gross value added in primary sector. In the similar manner, secondary sector or manufacturing or industrial sector, consider the total production produced in the secondary sector and deduct intermediate goods that they are used to produce the goods and services. From the total production produced in the secondary sector, if we deduct intermediate goods used, then you will get a gross value added. In the similar manner, under service sector, by providing total service minus intermediate goods they used, if you do that, you are going to get a gross value added. From primary sector, gross value added plus the gross value added in the secondary sector plus the gross value added in tertiary sector or service sector is equal to GDP or gross domestic product. From the gross value added by all the firms that may be in the primary sector, secondary sector or tertiary sector. From that, if you deduct a depreciation charges, then you are going to get a net value added. Dear students, under product method, when you are going to add final goods or use a final goods method, there may be a possibility of double counting. Sometimes, as we discussed under final good, it does not depend on nature of the good, but it depends on the economic nature of its use. So because of that reason, sometimes while we are considering the final goods, even sometimes we will consider intermediate goods, and if you include intermediate goods, then it becomes a double counting. In that situation, you can use a value added method. If we consider final goods that are produced in the economy together, then it is called as product method. Or you can consider the total sales by all the firms minus intermediate goods, then you will get a gross value added by all the firms. So GDP can also be represented as summation or sigma I equal to 1 to n gross value added by I firms or domestic firms. Now under value added method, if we consider, how can we calculate? Let me take one example. The consumer buys bread at rupees 1000. So that is the final good and the value of bread is 1000 rupees. And if you consider only the final good, then you have to consider the bread value is 1000. So GDP is equal to 1000 rupees. If we adopt value added method in order to avoid double counting, then you can see this chart. Here you can see See here, the farmer produces wheat and sells at rupees 500. Then what is the value added by the farmer? 500. Now this wheat is purchased by miller. After purchasing wheat at rupees 500, he sell the wheat flour at 700. So he is going to charge 200 for converting wheat into wheat flour. For converting into flour he is charging 200. So what we have to do, after converting the wheat into wheat flour, he is selling at 700. But actually for converting wheat into wheat flour, how much is charging? 200. So 700 minus 500, 500 is wheat and 700 is selling a wheat flour. But actually value added by the miller for converting wheat into wheat flour is 200. So you should add wheat flour value, that is 200, because miller adds 200 by converting wheat into wheat flour. In a similar manner, baker purchases wheat flour at 700 rupees and sell bread at 1000 rupees. 1000 rupees to that is he will sell to consumer and he buys bread at 1000 rupees. If you consider final goods method, then the bread is 1000 rupees and GDP is rupees 1000. But here he sells at 1000, but he uses wheat flour whose cost is 700. If we deduct that 700, you will get a 300. So baker man is charging 300 rupees for converting wheat flour into bread. So what is the value added by baker man? That is only 300. If we add 500, 200, 300, again you will get a rupees 1000, which is equal to value of final good. So either you can use value added method or you can use final good method. But in final good method, you should be very careful because sometimes there may be a possibility of double counting. But if we use a value added method, we can avoid that double counting. Dear students, now let us discuss expenditure method of measuring GDP. Before we take up this concept, let us discuss few things before understanding expenditure method of measuring GDP. There is a firm which is manufacturing sewing machine. If a consumer purchases machine, means this sewing machine, then it is called as consumption. For domestic purpose, if he is going to purchase, then this we call it as consumption expenditure. If government is going to purchase, either to supply for women to empower them at free of cost, then also it is called as government expenditure. So as government is going to make a payment for that firm. So firm receives payment or revenue receipts from consumers and it also receives from the government. In similar manner, if there is a private investor who is going to start a garment, and for garments what we want? The sewing machine. If he is going to purchase, then it is called as investment expenditure. It is called as investment expenditure. So the private investors who purchases sewing machine will come to firm. And at the same time, the firm may export to other country or to foreigners, and foreigners when they pay, then we call it as export earnings. What we call it as export earnings by a firm. I hope you understood this example. So firm is there who is going to manufacture sewing machine, Consumers purchases means it is called as consumer expenditure. If government purchases means it is called as government expenditure. If private investors, example I took a garments. For garments they need a sewing machine, and if they are going to make investment on this as a capital good, then it becomes an investment expenditure. And at the same time, when it is going to export to other countries, they will receive export revenue receipts, and that we call it as export earnings by a firm. So firm will receive payment from consumer sector, from government sector and private investment sectors, even from the foreign sector. Let us understand what is or how we are going to calculate a GDP under expenditure method. What's this RVI? RVI is nothing but sum total of revenues that firm I earns is denoted by RVI. I took firm, okay, sewing machine firm, and the firm I receives revenue from consumption sector, government sector, investment sector, and from foreign sector or export sector, or we call it as consumption expenditure in the form of consumption expenditure, government expenditure, investment expenditure, and export earnings. See, RVI is equal to sum total of, see here, sum total of final consumption expenditure, investment expenditure, then government expenditure, then you can see export earnings received by the firm I. I repeat once again, it is sum total of final consumption expenditure from consumers. It receives a receipts that we call it as consumption expenditure. From private investors, it receives receipts that we call it as investment expenditure. Government may also purchase these type of machineries, and government can have consumption expenditure and investment expenditure. Together we call it as government expenditure. Export revenue received by the firm. Now what is GDP? GDP is sum total of all final expenditure received by firm in the economy. How can we denote this one or simplify? GDP is equal to summation or sigma I equal 1 to n RVI. See, there are so many I forms. I took here one form as I, but in an economy there will be a n number of forms. So because of that reason we denoted that the revenue received by all firms in the form of this RVI is that nothing but a revenue received by firm I. So here the firm I is equal to 1 to n. First firm to nth number of firms, whatever the revenue received is shown by sigma I equal to 1 to n RVI, and this is equal all n number of firms will receive consumption expenditure, will receive investment expenditure, government expenditure, and revenue from foreign or from export earnings. We call it as sigma I equal to 1 to n. Xi is nothing but all firms earn revenue by exporting. Dear students, before we take up expenditure method, detailed explanation of expenditure method, first let us have little idea. So here I say C is nothing but consumption expenditure, and this consumption expenditure includes two things. One is consumption expenditure on domestic goods and services, and consumption expenditure on imported goods. When you go to market and buy goods and services, when you bring goods and services to home, just observe all those things which are produced within the country, that is denoted by consumption on Indian goods. Then if you identify all those goods which are manufactured outside the country, then we can consider that as consumption expenditure on imported goods. You can see consumption is equal to CI plus CM. What is that? CI stands for consumption expenditure on domestic goods. CM stands for consumption expenditure on foreign goods or imported goods. In similar manner, when you are going to make a private investment expenditure, when you are going to buy machineries, tools, equipment, maybe those tools, machines, equipments produced domestically. Then if you buy Indian machines, tools, equipments, then it is called as private investment expenditure on domestic goods and is denoted by II. IM stands for private investment on foreign goods or imported goods. That means you are importing capital goods outside the country, means that we call it as private investment expenditure on foreign goods. In similar manner, government expenditure to have two types, that is government expenditure is equal to GI plus GM. That means government expenditure on domestic goods and government expenditure on imported goods. Now let us discuss. Now we have to derive the equation of GDP is equal to C plus I plus G plus X minus M. How we got those? So there is a equation GDP is equal to sigma I equal to 1 to N RVI. You know RVI is nothing but a revenue received by I firm. In an economy there may be a N number of firms. So all the revenues, that is revenue received by first firm plus revenue received by second firm, and third one is revenue received by third and revenue received by firm I fourth one, like this. It will be up to RVI equal to N. Okay. So this is denoted in the form of sigma I equal to 1 to N RVI. And we know that already we discussed this is equal to sigma I equal to 1 to N. All firms who receives a consumption expenditure plus sigma I equal to 1 to N. All the firms from first firm to nth number of firm receive investment expenditure and summation I equal to 1 to NGI government expenditure plus sigma I equal to 1 to N all N number of firms who earns export revenue. So it is denoted are the expansion form of sigma I equal to 1 to N RVI. Now we know that CI, how you can derive CI? We know C equals CI plus CM. Previously we discussed. Now we want to find out this one. So for that what you should write? CI equals C minus CM. If C includes Ci plus Cm, if we deduct Cm from C, then the left out is Ci. So in this form, you are going to get the equation. So how you are going to get Gi? We want Gi. We don't want C. We don't want Cm. We don't want G. We don't want Gm. But we want Gi. To find out Gi, we need a government total government expenditure minus government expenditure on imported. So then if you do this total government expenditure minus government expenditure on imports, then you will come to know government expenditure on domestic goods. In similar manner, II if you want, take or consider total private investment expenditure. From that, if you deduct the investment expenditure on imported goods, then you will get. Okay. Now what we are going to do, we will substitute all these things here. Before that, let us remove all this. So you can observe here, dear students. So you can substitute the equation. Okay, here you can substitute. Let me show that one. Now you can substitute this sigma I equal to 1 to n RVI is equal to C minus Cm in the place of Ci plus G minus Gm plus I minus Im plus X. Then remove minus Cm minus Gm minus Im. The left out is C plus G plus I plus X. And whatever you removed, no, that should be denoted. All expenditure on imports are denoted by minus M. So that minus M you have to substitute here. When you substitute, you will get an equation like this. GDP equals C plus I plus G plus X minus M. So these we call it as components of GDP. So dear students, you can see here GDP equals sigma I equal to 1 to n RVI is equal to sigma I equal to 1 to n CI, sigma I equal to 1 to n II, sigma I equal to 1 to n GI, sigma I equal to 1 to n XI. Now what we will do in the place of this, you can see in the place of this, we are going to substitute. In the place of I equals 1 to n, we are going to substitute I minus Im. In the place of G, that is sigma I equal to 1 to n Gi, we are going to substitute Gm. When you substitute like this, from this all expenditure on imports will be separated and it is added and denoted by minus M. The left out one, C and I, G and X you need to write down, and all those things which we call it as expenditure on imports are denoted by I minus M. So you can see GDP is equal to left out C plus I plus G plus X we have written, and from that if we deduct a minus M, you are going to get GDP is equal to C plus I plus G plus X minus M, which is the formula for GDP under expenditure method. Dear students, this is very important for 6 marks and you have to write this much information for scoring 6 on 6. You can see here we discussed in detail with an example. Now easily you can understand. Sum total of revenues that firm I earns is denoted by RVI. Then RVI is nothing but sum total of final consumption expenditure, investment expenditure, government expenditure and export revenue received by firm I. GDP equals total of all final expenditure received by firms in an economy. So this is GDP is denoted like this. Sigma I equals 1 to n RVI is equal to sigma I equal to 1 to n sigma CI plus sigma I equal to 1 to n I sigma I equal to 1 to n GI sigma I equal to 1 to n xi. The components of final expenditure means private final consumption expenditure, and here you can see in the final consumption expenditure includes expenditure on imports of consumption goods. So CI stands for X minus XM. That means the part That means here CI is nothing but C minus CM. What is that I? CI, part of aggregate final consumption expenditure that is spent on domestic goods. If we consider I, it is a final investment expenditure. IM stands for investment expenditure on imported goods. If you want investment expenditure on domestic goods, then from the total investment, you have to deduct the investment on imports. The left out is II, and that II represents aggregate final investment expenditure on domestic items. Government expenditure, that is G, stands for expenditure that government makes on final goods and services, and GM stands for that part of government expenditure which is spent on imports. Now GI stands for government expenditure on domestic items. How you will get total government expenditure minus expenditure on imports? If you deduct, then you are going to get a aggregate government expenditure spent on domestic firms. Then exports, XI stands for exports or export revenues that firm I earns by selling its goods and services abroad. Then here you can see, dear students, M equals CM IM GM, which we brought outside the equation, and it is denoted by minus M. Now in the place of CI, II, GI and X, you can substitute these equations. Okay, so that is what is the equation? C minus CM, I minus IM, G minus GM, then X. So bring all the imported expenditure outside, and it is denoted by minus M. The left out is C, I and G you have to write here. The remaining X minus X is also you have to write down, and minus M, which we will use as a denotation for expenditure on imports. Dear students, income method is more easy and very quickly you can understand. National income is the result of combined and cooperative efforts put in by all the factors of production. After employing them, we have to remunerate them in the form of rent, wages, interest, and profit. What are the factors of production? Land, labor, capital, and organization. For land, you are going to pay rent. For labor, wages, capital, interest, and for organization, profit. In this method, we represent for rent R, or denote for rent R, for wages W, and for interest IN, and for profit P. If we add all the revenue, that all the factors of production received together, then you will get a GDP. How to calculate this one? GDP is equal to summation of R. Rent, there are so many landlords who will receive a rent. Take a total of all landlords or those who receive a rent together, and take a summation of W. That means all laborers wage together, then all interest together, plus all profits together. If you add all these things, then you are going to obtain GDP, and that we call it as income method. Dear students, if you like, please like, share and subscribe to my channel. Thank you so much.